Okay, let's unpack this because usually when you pull up a map on your phone, there's this expectation of absolute geographical certainty.
Right, yeah, you expect the roads to stay put.
Exactly. The app finds your blue dot and it draws a crisp line down Elm Street and tells you exactly how to reach your destination. North is north, south is south, and the roads don't actively try to change direction while you are driving on them.
Which would be terrifying.
It totally would. But the thing is, the moment you step into the world of global financial markets, specifically those technical charts that track global currencies, that comforting static map completely shatters.
Oh yeah, it's a totally different landscape.
Right. You are suddenly looking at a landscape that is constantly redrawing itself in real time. It's molded by the anxiety, the algorithms, and really the capital deployment of millions of participants all at once.
And it never stops.
Never. So today we are decoding that hidden language on the Euro to US dollar weekly chart. Our mission in this deep dive is to isolate the mechanics of the current ascending channel strategy so we can see exactly where this tug-of-war is heading.
And if you're listening to this and wondering if reading a currency chart is just some exercise in reading financial tea leaves, the reality is actually far more grounded than that.
It's not just magic lines.
No, not at all. We aren't looking at abstract lines. We are looking at the raw, digitized footprints of human psychology and institutional capital. Like every peak and valley on the EURUSD chart represents a very real moment where either buyers or sellers experience enough financial pain to change their behavior.
Which brings us to the macro environment. Because before you can trade the day-to-day noise, you really have to understand the architectural structure of the market you are currently standing in.
Yeah, you need the big picture first.
Right, so if you zoom out to the weekly time frame, the EURUSD pair has been trapped inside this incredibly well-defined ascending channel since September of 2022.
Which is a massive amount of time in the trading world.
It is. For anyone tracking this, 2 years is a huge duration for a single structural trend to hold up.
Yeah.
Literally week after week, the price has just been printing higher highs and higher highs and higher lows.
And that sequence of higher highs and higher lows, that is the textbook definition of a fundamentally bullish market.
Right.
But the mechanics of why an ascending channel forms over such a long period, that's what reveals the underlying market physics. It's just this ongoing cycle of accumulation and distribution.
So institutions buying and selling.
Exactly. Institutions buy the euro at the bottom of the channel, pushing the price up. And then once it hits an internal profit target, they distribute or, sell off a portion of those holdings, which causes a dip.
Makes sense.
But because the overarching macroeconomic sentiment favors the euro over the dollar right now, new buyers step in at a higher price than the previous dip. They don't wait for it to fall all the way back down.
Because they're eager to get in.
Right, and that urgency is exactly what creates the higher low.
Okay, wait, so picturing this in my head, is it sort of like walking up a bouncing staircase that's fully enclosed inside a long hallway?
Oh, I like that visual.
Yeah. So you keep moving forward, bouncing from the floor of the hallway up to the ceiling and then back down to the floor, but the entire hallway itself is tilted upward. You are constantly elevating, even when you are technically falling from the ceiling back to the floor.
That captures the geometry perfectly, actually. The floor acts as dynamic support and the ceiling acts as dynamic resistance. But here is where that structural upward momentum just slammed into a wall.
Ouch.
Yeah. Recently, the price hit the ceiling of that ascending channel and suffered a violent rejection.
Right. We bounced hard off the ceiling.
Exactly. And it didn't just happen at some arbitrary mathematical line. It aligned perfectly with the major weekly supply zone sitting right around the 1.208 level.
Okay, and a supply zone like 1.208E isn't just a random number, right? It's basically an active graveyard of old trades.
That's a great way to put it.
It's a place where massive amounts of selling pressure just live.
Yeah.
But why does that specific level trigger such an aggressive pushback from sellers? Like, if the hallway is tilted up, why wouldn't the buyers just blast straight through it?
Well, it's because the market has a very long, very unforgiving memory. A supply zone is formed when, at some point in the past, a massive imbalance occurred.
An imbalance between buyers and sellers.
Yes. At 1.2080, institutions, central banks, and algorithmic models previously determined that the euro was fundamentally overvalued compared to the dollar.
So they sold.
They initiated massive sell orders, so many, in fact, that the market couldn't even fill them all before the price collapsed.
Oh, wow.
So those institutional sell limit orders just sat there, dormant, waiting on the books for years. And when the price finally bounced back up to 1.2080 inside our current ascending channel, it triggered all of those sleeping sell orders simultaneously.
It's like an avalanche of latent supply suddenly hitting the market all at once.
Precisely. And it establishes a definitive, hardened ceiling for this current bullish phase. Now, it doesn't mean the long-term ascending staircase is completely broken.
The trend of higher lows is still technically intact.
Yes, exactly. But it proves that the buyers have temporarily exhausted their capital exactly where the sellers had pitched their tents.
So we hit our heads on that macro ceiling at 1.2080. Now we have to look at the micro reality of the fallout, because the drop from that ceiling has been severe.
Very severe.
The EURUSD is currently trading way down around the 1.1390 level, and on the way down, it broke through a very specific floor. The price is now sitting below the 21-week exponential moving average, or EMA.
What's fascinating here is the contrast between that macro trend and this micro breakdown.
Yeah, because that cross below the 21-week EMA is the chart's way of signaling that short-term momentum has fractured. But I actually want to pause on the mechanics of that indicator for a second. Sure. Why specifically a 21-week moving average? Is this moving average acting like the short-term heartbeat of the market, and dropping below it triggers something structural? Like, why 21?
So to understand the weight of the 21-week EMA, you really have to look at how algorithmic trading models are programmed. The number 21 itself isn't magic, but it translates to roughly under trading days.
Oh, I see.
Yeah, and in the institutional world, a 100-day look back is a standard, highly calibrated metric for medium-term trend identification.
And it's an exponential moving average, not just a simple one.
Right, an EMA mathematically heavily weights the most recent price action. So it smooths out the chaotic daily noise, but it reacts super aggressively when the immediate prevailing winds shift.
So if an algorithm is tracking the 21-week EMA, it's basically constantly asking, what have the buyers done for me lately?
Exactly. And when the price consistently closes below that line, millions of automated trading bots flip their internal bias.
You just switch modes.
Completely. They stop looking for opportunities to buy the dip, and they start looking for opportunities to sell the rally. The immediate aggressive buyers who were driving the market up the staircase have basically stepped aside, allowing the sellers to dictate the daily pace.
So the macro structure, the grand hallway, is still pointing up. But the micro reality, the algorithmic bots and short-term sellers, are actively dragging us down right now.
That's the conflict we are seeing.
We know the market is slowing down, but to really understand the physics of this exhaustion, we have to look under the hood at the momentum indicators, because falling below a moving average is just a reaction, but momentum indicators actually show you the underlying cause.
I show you the energy behind the move.
Right. And the relative strength index, the RSI, is currently flashing a massive, unavoidable warning sign called Bearish Divergence.
And Bearish Divergence is arguably the most powerful diagnostic tool a trader has, because it separates the illusion of price movement from the actual reality of market participation.
You know, I'm trying to visualize how this actually functions in the real world, because the chart shows that the actual price of the EURUSD recently pushed to a higher high like. The number on the screen went up.
Right, the price is higher.
But the RSI indicator failed to match that peak and actually made a lower high. To me, it feels like revving a car's engine going up a steep mountain road.
Okay, I can see that.
The car might still be rolling forward, making higher highs up the elevation, but the engine's RPMs are actively dropping. The horsepower is dying even while the momentum carries the chassis a few feet further.
That car analogy translates perfectly to the order book. Seriously. Because when you see the price pushing higher, you assume it's because a flood of eager buyers is aggressively hitting the buy button at market price, eating up all the available supply.
Because that's what true, healthy momentum looks like.
Right. But the RSI formula measures the speed and magnitude of recent price changes. So when the RSI drops while the price goes up, it reveals a structural hollow point. It means that final push in price wasn't actually driven by new aggressive capital entering the market.
Wait, if it wasn't new buyers, how did the price even go up?
Well, often it's driven by a lack of liquidity or by short sellers closing out their positions.
Which technically requires them to buy.
Exactly. It's defensive buying, not offensive buying. The aggressive market buyers have vanished. The engine is sputtering.
Wow.
So when you see that kind of bearish divergence right at the top of a massive channel against a hardened 1.208 supply zone, it tells you the car isn't just going to slow down. Gravity's about to take over, and it's going to roll backward down the hill.
Which brings us to the most urgent question for anyone with capital on the line. If the RSI and the moving averages are all pointing to a deeper correction, How deep does the car roll before it finds traction again?
That's the million-dollar question.
And here's where it gets really interesting. The geometry of the chart introduces a specific target through something called the Bearish Shark Harmonic Pattern.
Yes, the shark pattern.
And I have to be honest, when you first hear terms like Bearish Shark Harmonic Pattern, it sounds dangerously close to trader astrology.
It does sound a bit wild.
I mean, we are talking about mapping geometric shapes to predict global capital flows. How does that even work?
If we connect this to the bigger picture, it sounds like we are drawing constellations and just hoping the market obeys them. But harmonic patterns are really just visual interfaces for mathematical ratios, specifically Fibonacci sequences.
Okay, Fibonacci.
Yeah, and while Fibonacci numbers are famous for appearing in nature, their application in financial markets is purely structural. They mathematically map out the expansion and contraction of herd behavior.
But how does a mathematical ratio actually force a human being or even a trading algorithm to buy or sell a currency at a specific price point? It's not magic.
No, it becomes a self-fulfilling programmed reality. Major financial institutions build their algorithmic execution models around standard deviation and Fibonacci retracement levels.
Because they need standardized rules.
Exactly, because those levels offer standardized, mathematically sound risk-to-reward parameters. The Bearish Shark Pattern specifically tracks a unique sequence of price swings. You have an initial drop, then a false recovery that traps retail buyers who think the trend is resuming, and then a final aggressive flush downward.
A trap for the little guys.
Basically. But the critical piece of this pattern is the final destination, which is known as the D point.
Right, the geometric D point.
And the D point isn't some mystical coordinate. It's the exact mathematical intersection where those algorithmic models are programmed to take their short profits and reverse their positions to go long.
So it's literally a line of code executing a massive influx of buy orders at a highly specific mathematical ratio.
You nailed it.
And what makes this current setup so fascinating is where this projected D point lands. It sits right near the lower boundary of that massive long-term ascending channel we talked about at the very beginning.
It lines up perfectly.
The mathematical extreme of the short-term drop aligns perfectly with the structural floor of the 2-year trend.
And in technical analysis, that overlap is called confluence. It creates what is known as a potential reversal zone, or PRZ.
PRZ, got it.
Think of it as structural reinforcement. You don't just have harmonic traders looking to buy at the D point. You also have macroeconomic trend traders looking to buy at the bottom of the ascending channel.
Oh, I see.
So when those two completely different methodologies point to the exact same price level on the chart, the concentration of pending buy orders becomes massive.
It's like two different treasure maps created by two different cartographers, and the X is drawn on the exact same patch of dirt.
Thanks.
So we have the overarching macro trend, we have the fading micro momentum pulling us down, and we have the shark pattern target waiting below to catch us. Now we have to synthesize all of this competing data into actionable battle lines.
Which is the hardest part.
Because mapping the market is useless unless you know where to deploy your capital and where to place your protective stops.
So what does this all mean for someone looking at the chart right now?
This is where theory translates into execution. You have to clearly define your areas of risk and your areas of opportunity.
Okay, so the chart analysis maps out two specific zones that basically dictate the immediate future of the eurodollar.
Right.
The first major demand zone, which is the immediate floor where buyers are expected to try and catch this falling price, sits between the 1.108 and 1.1250 levels.
And if the buyers step in there and successfully defend that zone, we could see a rebound rally pushing the price right back up to the first supply zone.
Which is camped out between 1.1550 and 1.1780.
Yeah, that is the immediate ping-pong table for short-term traders. It's a localized tug-of-war. But the data is very clear about the downside risk here. If that rebound rally fails, and the sellers regain absolute control at that 1.1550 to 1.1780 supply zone, the bears will likely drive the price straight down, slicing right through the initial demand zone.
Tearing right through it.
Yeah, and if that floor breaks, there's basically nothing stopping the pair from plunging directly toward that harmonic D point at the bottom of the macro channel.
It's a steep drop from there.
So how do you trade a market that is fundamentally bullish in the long term, but aggressively bearish in the short term? It feels like you have to hold two contradictory beliefs in your head at the exact same time.
You really do. It requires a highly disciplined, almost paradoxical tactical mindset.
It sounds stressful.
It is. You must respect the immediate gravity, The fact that short-term momentum and the algorithms are pulling the price down right now, the sellers are actively steering the ship, but you simultaneously cannot forget that the broader ocean current, the grand structural channel, is still flowing upward. The synthesis of all this data demands one core behavioral trait from the trader, and that's absolute patience.
Because the urge is always to predict the bounce before it even happens, right? To place a limit order exactly at 1.1080 and just cross your fingers and hope the floor holds.
Which is exactly how amateur traders get crushed. You never blindly buy at a demand zone, and you never blindly sell at a supply zone. These zones are areas of interest, not concrete walls.
They're more like suggestions until proven otherwise.
Totally. Professional traders wait for definitive price confirmation at those levels. When the price hits 1.1080, you watch the order flow. Are institutional buyers stepping in with massive volume, creating a violent rejection of lower prices?
Or is the price just bleeding through the zone like a knife through butter?
Right. You have to let the market reveal its hand before you commit your capital. And, crucially, you apply strict risk management. Because technical charts measure probability, not absolute certainty.
Yeah, because one sudden macroeconomic shock like an unexpected interest rate hike or some geopolitical crisis, and even the most perfectly aligned bearish shark pattern gets completely obliterated by raw panic.
Yep. The chart tells you what the crowd is likely to do under normal conditions. It definitely doesn't protect you from a stampede.
Well, we have covered incredible ground today in this deep dive. We established the macro environment, mapping an ascending channel that has governed the euro and the dollar since late 2022.
It's a huge structure.
It really is. We identified the massive institutional supply zone at 1.2080 that acted as a hardened ceiling. We watched the short-term momentum fracture as algorithmic trading bots flipped bearish after dropping below the 21-week moving average.
And we looked at the order book mechanics driving the bearish RSI divergence, which exposes the lack of aggressive buyers.
Right. Then we tracked the mathematical geometry of the bearish shark pattern down to the potential reversal zone, and finally drew the actionable battle lines between the 1.1080 demand zone and the 1.1780 supply zone.
Quite a map.
It is a brilliant look at how technical data translates into human behavior, but it actually leaves me with one final lingering thought, just something for you to mull over the next time you pull up a currency chart.
Oh, the philosophical exit. Let's hear it.
When technical patterns like the bearish shark and structural boundaries like ascending channels align perfectly with historical supply and demand zones, are we simply measuring organic human psychology on a massive global scale?
Huh?
Like, are these charts just a pure reflection of the natural ebb and flow of human fear and greed? Or, and this is what gets me, do these technical levels become self-fulfilling prophecies?
The ultimate question.
Right. Does the price bounce at the D point simply because millions of human traders and thousands of institutional algorithmic bots are all looking at the exact same mathematical lines on the exact same screens and pushing the buy button at the exact same time?
Are we predicting the behavior of the crowd, or are we just the crowd reacting to our own prediction? It really is the ultimate paradox of technical analysis.
It's definitely something to chew on as you watch the euro and the dollar battle it out this week. If you want to stay ahead of the markets, make sure to head over to our YouTube channel, Investor's Edge, subscribe, and like the video.
Subscribe and like the video. Thanks for diving in with us.